Most traders think supply and demand is just drawing boxes on a chart. That is why it keeps failing them. Supply is selling pressure and demand is buying pressure. But the real supply and demand is not random. It is where premium selling and premium buying actually happens. This is where institutions enter the market with big sizes. This is where a price was forced to move. And this is why a price reacts so precisely from certain levels and ignores others. If you don't understand the pressure behind a zone, you are just guessing. And in this video, I'm going to show you how to read supply and demand the correct way, how to identify zones that actually matter, how to stop marking the charts in a way that puts you on the wrong side of the market. And once you understand supply and demand properly, your chart gets cleaner and your bias gets clearer. And price finally starts to make a lot more sense. By the way, my name is Jamal. Welcome back to FOREXSOM again. And here we are with another episode. Right in front of us, we have a couple of things. Here we have a note. Zone, you're gonna go ahead and mark the origin of the impulse. Okay, before the break of structure, you're gonna go ahead and mark the origin of the impulse, which is the supply zone right there. All right, and then once the price returns, number 6, once the price returns back to the supply zone, this is where you're gonna be looking for your opportunity to execute a trade. Okay, 7, you only trade in one direction. If this is a downtrend and you already marked your supply zone, you're only looking for a down move. You're not looking to buy this market. You're looking to sell this market from a supply zone. All right? Remember again, the more you keep your chart clean, the more you be able to identify which direction you should be trading. Clean chart equals to clear bias. Okay? Structure equals to direction. Once you identify the structure of the market, which is the direction of the market, then you're going to go ahead and mark your supply and demand zones, which is the location where you're going to be executing the trade at. And then you're going to go ahead and identify your liquidity zone, which is where the price will react and not reverse from. Okay, now let's put this aside. Now we're going to go ahead and move into the bullish market structure. Okay, so here we have a market creating high high, high low, high high, high low, and then continuation to the upside. This is not a valid high high yet unless we get a pullback. Remember, All right, for a uptrend market structure, first we identified this is an uptrend market structure. Price technically creating a high. So now that we get this out of the way, before I move ahead into the real chart, please go ahead and take a screenshot for your own notes. And once you're done, we can go ahead. Now that you did that, let's go to the real chart. All right. Now let's go to the real chart. All right. First thing first, let me get this with me. This is our notes. We need this. So you could use this. You can identify the direction of the market on every time frame, regardless. Okay. If you are a day trader, I suggest that you look for your supply and demand zones on the higher time frame, like the 4-hour time frame. So here we have a downtrend market structure. We have market creating a higher low, higher high, higher low, higher high, higher low, higher high, higher low, and then a change of character. Okay, and then a change of character. All right. All right. So here we have number one, we identify the direction of the market, which is a downtrend market structure. We're not looking at anything else. We only focus on the direction of the market here first. Okay. Identify market structure first. So we executed the first rule, which is to identify the direction of the market, which is a clear downtrend, as you can see right here. Second, we wait for a break of structure. We wait for what? A break of structure. All right. Go ahead and mark your break of structure. Now that we have a break of structure, what do we do next? We can see market reacting And once the price gets to this area, this is where our interest is. And this is where the premium area is. If you grab your Fibonacci levels and you mark from here to the down move, this is the 50% area of the down move. This is the 50% of the supply zone area, okay? This is where the institutions filled their large orders. This is where they executed their large orders. So once they make the price move rapidly from here, they're not able to fill most of the orders at the same time. So now the price has to go back again to fill the rest of the orders. So when the price comes back to this zone, they're gonna go ahead and execute the rest of the orders, because remember, they're not like a retail trader where you're able to fill your order within one click. Since they're trading and moving millions of dollars, they're gonna have to have enough buyers to buy from, enough buyers because since this is they're selling over here, there has to be enough buyers for them to sell. So now they wait, they fill some of the orders over here, they create this impulse that created the break of a structure, and then now they're gonna go ahead and fill the rest of the orders now that they have enough buyers at a basically a premium zone, okay? At a premium zone, which is the 50% of the Fibonacci ratio. All right. So what else do we have now? We talked about price reacting to a certain level, which is, which is the liquidity zone. Remember, this is where price reacts. Price doesn't reverse from here. To the break of structure. So you get to be able to wait for a major supply zone or a major demand zone before you execute a trade. Okay, you can see this was the market right here originally, and this was an internal market structure. So don't worry about the market structure, the internal market structure. Focus on the bigger picture. What's going on the left side? Okay, don't just look at what's going on in this internal market structure. So now that you understand that you should be waiting for the price to come back to a supply zone, now once the price gets over here, you have two options. Either you execute, you go to lower time frame and then execute right after the price hits, takes out liquidity and then hits this supply zone, and take that risk, which is a very impulsive risk, but minimum stop loss, because your stop loss is not too big. Once you execute a trade from here, you have a very small stop loss. Or either you wait for the price to create a change of character and then execute a trade right here to continue to the downside, and then now target the external liquidity zones. Okay? All right. Now that we identify this, now we have another break of a structure. Here, move this. We have another break of a structure. Same thing happens over here. If you have eyes, you can literally see what's going on over here. Price moved from here to here, and then pulled back, and then all the way down again. So what happened over here? Okay, we can see price creating a break of a structure, which we have it over here. They're not well informed. They're very impatient. They don't look at the bigger picture, which is right here. They only focus on this move here. And this is where they get chopped up. You can see how chopped up this is. But you can see the big moves before the break of a structure. Now they're going to be selling here, 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 here. They're selling everywhere. All right? But smart money traders are very intelligent. What they do is they know they fill some of their orders over here. They know price has to go back to a premium zone in order to execute the rest of their orders. If you grab your Fibonacci levels and you put it from here, swing high to swing low, you can see this is a well designed supply zone. You can see this falls on the 78%. This is as cheap as it can get. Okay, so the supply zone falls onto the 78% of the Fibonacci levels. Okay, now they're gonna go ahead and execute the rest of the orders over here. But what did they do before they do that? They took out this liquidity, this liquidity, this liquidity here, and then here. They collect all of this liquidity because there were sellers that was selling here, selling here, selling here, selling here. Okay, each time they sell, they put their stop loss above the swing high, which is an internal structure, and this is where they get chopped up. All right, you never execute a trade over here. You wait for the market to go back to a supply zone, and what it does, you have two options. Either you execute the trade right away, or either you go to the lower time frame and wait for a change of character. High, 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 low, high, 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 low, and then you execute your trade on a confirmed location. Okay, target this external liquidity zones, because remember there was buyers entering the market from here before the market went back to the supply zone. Now that we have a bullish break of a structure, we're going to be looking for a demand zone. Okay, the demand zone is right here. This is the origin of the move right here, okay? So now we're going to go ahead and mark our demand zone. Once we identify the direction of the market, we went ahead and marked our demand zone after this change of character, because this change of character also equals to a break of a structure because we broke a structure. All right. Now we're going to go ahead and mark our demand zone. Now that we marked our demand zone, we wait for the price to come back to a demand zone, because remember, the buyers, they filled some of the orders right here, and when the price comes back to the zone, they have to fill the rest of their orders after they collect liquidity, because they need enough money or enough liquidity in order to fill the rest of their orders. For them to buy, there have to be enough sellers so that they can buy it from them. All right. So now what they do here is, a lot of retail traders, they don't focus on what's going on right here. Their problem is they're only focusing on what's going on within, the internal market structure. But what happens over here is price, they're going to go ahead and mark this area. They're going to say, oh, this is the demand zone. Price is going to react for a little bit. But what happens after that is the stop loss is sitting right beneath here. And you know what happens after that? The liquidity gets collected. Price comes back again. Thinking price is going to go up, but then the big players, they come down and then take their liquidity, because now they have enough, because there was enough orders that was happening over here. There was enough buy and sell. As you can see, anytime you see a range in market, there was enough orders that was executed right here. So all these buyers and sellers that was trading this range, they put their stop loss right here. Okay, now what happens? Big players are going to come in, grab your Fibonacci, put it up. Now you can see they executed a trade at the 38%, which is not a very strong area, but at least they have enough liquidity after they took out this zone to fill the rest of their orders. And then again, another break of a structure. Market went up, created a liquidity. Retail traders try to execute over here because they see this, down candle before the up move. But we go ahead and mark our origin of the move, which is right here. Retail traders, they started buying. Market comes back again, reacting. and then creating a little bit of move, but then they put their stop loss over here. Then what happened after that? Now they have enough liquidity to fill the rest of their orders. Okay, now they execute another order right there. So this is how you execute supply and demand zones. All right. By the way, my name is Jamal, and this is another episode about supply and demand zones. I'm going to try to talk about Fibonacci and all the rest of the stuff later on. If you're brand new to the channel, please go ahead and subscribe. All the links are going to be in the description down below. And by the way, until next time, please stay healthy and be careful. Happy New Year's. See you on another video. Bye.